What if I told you just 5 ETFs could outshine 90% of professional fund managers? Even someone like Eric with no Wall Street experience could do it. These ETFs could redefine your portfolio in 2025, combining cutting-edge growth, steady dividends, and rock-solid diversification. Today, I'll show you and Eric how to invest like a pro without breaking the bank. Eric was surprised to learn that 80 of the 100 stocks in the QQQ are also in the SPY. This means there's more overlap in popular ETFs than most investors realize. In this video, we're diving into 5 standout ETFs from over 3,500 options, focusing on what makes them top picks for 2025. We'll explore everything from expense ratios to 10-year returns and discuss the future prospects of each ETF. Trust me, this is the only video you and Eric need before making your next investment decision. But first, let's start with the basics. What exactly are ETFs? Let's break it down. ETFs, or exchange-traded funds, are baskets of stocks or other assets that you can buy and sell just like a single stock. They allow you to invest in a wide range of companies, sectors, or asset classes without requiring you to select individual stocks. So, why should you and Eric consider investing in ETFs in 2025? For one, ETFs offer instant diversification, which helps reduce risk, especially in volatile markets. They also come with lower fees compared to mutual funds, making them a more cost-effective way to invest. With the potential for long-term growth, especially in sectors like tech or green energy, ETFs are poised to remain a top choice for investors like you and Eric. Now, let's dive into the 5 ETFs you want to know about for 2025. Let's start with one of the most popular ETFs, the Vanguard S&P 500 ETF, ticker VOO. This ETF is designed to track the performance of the S&P 500 index, a benchmark that represents the 500 largest U.S. companies. It's essentially a snapshot of the U.S. stock market's biggest players. The numbers that matter for VOO: total assets, $1.35 trillion, making it one of the largest ETFs. Number of holdings, 505. Top 10 holdings include giants like Apple, Microsoft, and Nvidia, which collectively account for 37.32% of the fund. Expense ratio, just 0.03%, making it one of the most cost-efficient ETFs on the market. Dividend yield, 1.27%, with dividends distributed quarterly. Dividend growth rate, 7.23%. Now just have a look at the performance. 1-year total return, 28.25%. 5-year total return, 94.66%. 10-year total return, 254.47%. Why VOO is a strong pick for 2025. The new year could be a game changer for sectors like AI, and VOO is perfectly positioned to benefit. Tech remains the dominant sector in the ETF, with companies like Microsoft, Amazon, Meta, and Alphabet expected to collectively spend $300 billion on AI chips and infrastructure, according to Morgan Stanley. But VOO isn't just about tech. It's also diversified across industries, holding stocks like Eli Lilly in pharmaceuticals, Costco wholesale in retail, and McDonald's in fast food. This balance between tech innovation and established industry leaders makes VOO a reliable choice for steady growth and diversification. Number 2, we have the Invesco NASDAQ 100 ETF, ticker QQQM. This ETF tracks the performance of the NASDAQ 100 index, which consists of 100 of the largest non-financial companies listed on the NASDAQ stock exchange. The number that matters about QQQM, total assets, $39 billion. Number of holdings, 102. Top 10 holdings include tech giants like Apple, Microsoft, Nvidia, and Amazon, which together make up over 51.67% of the fund. Expense ratio, 0.15%, is affordable for an ETF focused on high-growth companies. Dividend yield, 0.61%, with dividends distributed quarterly. Dividend growth rate, 16.32%. Now just have a look at the performance. 1-year total return, 26.16%. 5-year total return, 75.68%. 10-year total return. Data is limited for QQQM, but it mirrors QQQ, its sibling ETF. Why QQQM is a strong pick for 2025? QQQM is a slightly smaller, lower-cost alternative to its sibling ETF, QQQ. but it offers the same exposure to the NASDAQ 100 index, which tech giants dominate. In 2025, as artificial intelligence, cloud computing, and other tech innovations accelerate, QQQM is set to benefit from these trends. But QQQM isn't just about tech. It also holds innovative companies in other sectors, like PepsiCo in consumer services and Amgen in healthcare, adding a nice layer of diversification. Number 3, we have one of the hottest sectors in the market right now, the semiconductor industry. The VanEck Semiconductor ETF, ticker SMH, is designed to track the performance of the MVIS US-listed Semiconductor 25 Index, which includes 25 of the largest and most influential semiconductor companies in the world. If you want to capitalize on the growth of technology, particularly in areas like AI, cloud computing, and data centers, SMH is an ETF to watch. The numbers that matter about SMH: total assets, 24.49 billion number of holdings, 25 top 10 holdings. These include semiconductor giants like NVIDIA, Taiwan Semiconductor, ASML, and Intel, which together make up over 72.79% of the fund. Expense ratio, 0.35%, a bit higher than some other ETFs, but reasonable for an ETF focused on a specific high-growth industry. Dividend yield, 0.42%, with dividends distributed annually. Dividend growth rate, 10.84%. Now just have a look at the performance. 1-year total return, 39.10%. 5-year total return, 28.77%. 10-year total return, 25.79%. Why SMH is a strong pick for 2025. The semiconductor sector isn't just growing, it's exploding. AI, 5G, and data centers are pushing demand for chips through the roof. Companies like NVIDIA, which is leading the AI revolution, Taiwan Semiconductor, and ASML are at the forefront of this technological shift. In addition to its strong tech focus, SMH also provides diversification within the semiconductor industry, with holdings in major players across different subsectors, from memory chips to fabrication equipment. As industries like AI and cloud computing explode, demand for semiconductors will only increase, making SMH a prime choice for 2025 and beyond. Number 4. If you're looking to add some steady income and dividend growth to your portfolio, the Schwab U.S. Dividend Equity ETF, ticker SCHD, is an excellent choice. This ETF focuses on high-quality U.S. dividend-paying stocks that have a strong track record of financial stability and consistent dividend growth. It's perfect for investors who want to earn passive income without sacrificing long-term growth potential. The numbers that matter about SCHD: total assets, $30 billion. Number of holdings, 103 top 10 holdings. These stocks make up 40% of the fund's total assets, including home-run names like Johnson & Johnson, Procter & Gamble, and Pfizer. Expense ratio, 0.06%, extremely low for a dividend-focused ETF. Dividend yield, 3.63%, paid out quarterly. Dividend growth rate, plus 12%. Now just have a look at the performance. 1-year total return, 11.60%. 5-year total return, 41.96%. 10-year total return, 110%. Why SCHD is a power play for 2025. The ETF's average dividend growth rate over the past decade has been an impressive 18% per year. That's more than 4 times the average inflation rate. With its focus on sectors like consumer defensive, healthcare, financials, energy, and industrials, SCHD offers both stability and diversification. Plus, the ETF has 11 consecutive years of dividend growth, which is a testament to the quality of the companies it holds. Whether you're reinvesting dividends for compound growth or collecting passive income, SCHD stands out as a solid, foundational ETF for dividend-focused investors. Number 5, we have the Vanguard Total Stock Market Index Fund ETF, or VTI. This ETF is the ultimate all-in-one solution for investors looking to gain broad exposure to the entire U.S. stock market. It tracks the performance of the CRSP U.S. Total Market Index, which includes large, mid, small, and micro-cap stocks. Essentially, it's a snapshot of the entire U.S. economy. If you want a one-stop shop to diversify your portfolio, VTI is a fantastic choice. The numbers that matter. VTI. Total assets, 1.78 trillion. Number of holdings, 4,000 plus top 10 holdings. includes major players like Apple, Microsoft, Amazon, and Tesla, which together make up around 32.38% of the fund. Expense ratio, 0.03%, incredibly low for such broad exposure. Dividend, yield, 1.24%, paid quarterly. Dividend growth rate, 7.83%. Now just have a look at the performance. 1-year total return, 27.96%. 5-year total return, 75.52%. 10-year total return, 180.87%. Why VTI is a must-have for 2025? VTI is the ultimate diversified ETF. As an investor, you don't have to worry about picking individual stocks or sectors. VTI covers everything from the biggest players in the S&P 500 to emerging small-cap stocks with huge growth potential. With its incredibly low expense ratio, it's also one of the most cost-effective ways to invest in the entire U.S. stock market. As the U.S. economy continues to evolve and grow, VTI will be a solid long-term option for investors who want to capture the broad movements of the market. So there you have it, the top 5 ETFs to buy for 2025. But the journey doesn't end here. If you're serious about building wealth in 2025, the next step is all about monthly income, and I've got just the video for you. Click the video now.